All right. Hello, everyone. My name is Kyle Hershey. I am the Chief Operating Officer of the Mortgage Calculator here, joined by Nick Hershey, the founder and president, and Jose Gonzalez, the sales manager. So, what we're going to do here today for our loan officer training is talk about bank statement loans. So, I'm going to have Jose explain a little bit about bank statement loans, how they work, when we would use a bank statement loan with a borrower, and then Nick's going to actually go through and do some bank statement calculations. So, Jose, go ahead and take the floor from here.
How's it, how's everybody doing tonight? All right, thanks for joining us. Now, bank statement loans are the most popular non-QM loans being originated. As you would imagine, in the last 12 months, since interest rates started rising due to a number of different economic factors, bank statement loans popularity and origination has increased, I believe, like 60 something percent, namely because as the interest rates uh, rose, the affordability of the homes went down, right? And if you were a full doc borrower where your income is what it is, maybe it's going to go up 3%, 4%, whatever it is, you're not going to be able to keep up with the spread in what your new payment's going to be at 6% versus 3% that it was last year. So what has ended up happening is that the self-employed borrower who had the choice of going full doc or other alternative doc options that are available to full doc borrowers, um, went and opted to go the bank statement route to be able to qualify for more income. So, with that little backdrop, when would we be using bank statement loans, right? Well, first and foremost, it has to be a self employed borrower. Cannot be, well, they have to be self employed. Now, I backtrack a second. They could have for some of our conduits, we can have a W 2 component to their income separate and on different, not counting that as their bank statement deposits, separate from their self employment income. And some of our conduits will allow, so we do have options that we will allow a borrower to have W 2 income plus a set from a separate employment bank statement income as well. So that's very interesting. And if they have a rental property, they could have a third component as well, which is all going to be treated differently. So the most common example of the bank statement loan would be the self-employed borrower who is reporting, moderating their income to mitigate their tax liability, and definitely makes has good cash flow and can document a good amount of income. So you could have this borrower. We have them where the tax return shows maybe $1,000 a month, and we get them qualifying for $30,000 a month on bank statements. And typically, um, you're going to consult the guidelines from whichever outlet you're thinking of sending the loan, because that is what is going to determine certain factors like the expense ratio. Most of them will default to 50% of the deposits unless you have a letter from a tax preparer or a CPA or an accountant where they're going to state a certain profit factor for the business or expense factor. Basically, they're going to say, okay, the expense factor is 30, so you're going to give them 70% of the bank statement amount. But again, I state the most important thing there is to look at the guidelines of wherever you're going to send the loan or wherever we decide, so that then we can have the proper documentation, proper credit matrix, everything lined up, right? So in general terms, you can use personal bank statements, you can use business bank statements, again, depending where you're going to be submitting the loan. So you have the self-employed borrower, You're getting the maximum income. Now it all depends what they want to buy, what their down payment is, if they're purchasing. This opens up a whole slew of opportunities for this borrower. I mean, with $30,000 a month of income, right, you're going to pretty much call the shots on where you want to go, depending on what you really want to pay monthly for your payment and what you have for your down payment, and what are the taxes and all that kind of good stuff. And the insurance, obviously, because in some places insurance is very expensive. So, with that being said, great opportunity, self-employed borrowers. Now, what are some of the pitfalls of the bank statement loan? What do you have to worry about? Well, again, I go to the guidelines. You're looking at 2 years typically that they have to be in business. Again, in some cases, you can show continuity if they were doing the same work possibly before. So those are all things you have to check with the guidelines and with the AEs. Also, they can help you definitely in that spot. So some of the pitfalls is obviously that, or worse, NSFs or overdrafts. Most cap it at 3 in a 12-month period. I think there's a couple that may allow 5 in a 12-month period. But if you have more than that, then and you can't get an exception. A couple told me, yeah, we do grant exceptions. I don't think they're going to grant you like 8 NSFs in a 12-month period. Now, again, you got to see if the overdrafts were connected to another account where they were actually paid for from another account of the borrowers, and it wasn't just like an overdraft service, like we're going to pay your check, only charge you $25, but we're going to pay your check, we're not going to return it. That they're going to have a problem with. What they will probably let you off the hook with is if they maybe have another overdraft service linked to another account that they have, then you're good. But other than that, then you're going to have to go P&L, profit and loss, as long as they don't have those overdrafts and kind of stuff in the last 2 months, because you do have to provide usually 2 months bank statements. But again, I ask you to refer to the guidelines of where you're going to send the loan, because some may only ask for 1 month. So there are a lot of very good options we're getting in the rates. Do you want to show some rate examples there, Nick?
What I'm gonna do my sample, and then I'm gonna quote my sample here once I get, because I got some sample data, and we'll just pull it up live and see what happens. I think.
All right. Well, you're pulling up. I'm going to state the last couple of bullet points to worry about, to be concerned with in the bank statements is declining trends of the deposits. So if the trend is down in the last 12 months, that's why we usually don't like to go 24 months out. We like to keep it at 12 months, because the longer you take that look back period, the harder it is to keep that trend stable or, not from being down. You want it to be tracking up, right? So definitely declining trends, and also be on the lookout very closely in the guidelines for guidelines that require a P&L for the bank statement, because they're out there. I will tell you that the easiest bank statement that I've worked is A&Ds. They don't ask for a P&L, and they allow you to use personal bank statements. They also allow you to use business bank statements. They ask for usually a business narrative letter. That's it, and a third-party verification letter from a tax preparer. But again, no P&L. So read the guidelines, because some do ask for P&L. Some say you can give a business narrative instead of the P&L, but they do ask for additional stuff. So be on the lookout for that. Don't be surprised. Like LoanStream, I believe they are full P&L only on the bank statement. So check the guidelines out for sure. But don't, because the whole purpose there is, what if your borrower says, listen, I'm doing this because I don't really want to go to the accountant for any kind of numbers, right? And then all of a sudden they hit you with a condition, oh, you got to give me a P&L also. Oh, now you got to resubmit that loan somewhere else. When you go to your borrower, he's going to say, hey, I thought I told you I didn't want it. I have to provide any reported numbers from the accountant. So, all right. So
what kind of, Jose, what kind of credit scores are people usually looking at for that program?
Well, again, that is going to depend on the loan to value. I believe, you'd have to look at the matrices, but I think I may have seen some as low as 620 and up. But at that point, it depends if it's, primary, it depends if it's investment, if it's rate and term, cash out, purchase, all that affects the credit score requirements and the risk associated with the file.
Okay. All right. Well, let's go ahead and have Nick take over here then. I know you have some bank statements that we're actually going to do the calculations on. And then, as you said, I guess you're going to do a quote for it as well. So go ahead and take over there, Nick.
Yeah. Let me try to throw the chat up here. If you guys have any questions, I can throw the chat up here once we open it up to questions. So I see a lot of people are chatting in there. So we will open up a question time where we can throw questions in there. But first, let me get through kind of what I have set up as a demo. So basically, as Jose said, we have a ton of options. It all depends on the guidelines, as everybody here knows. So to get us all in the same place, so we have the basics of a file, I want to go through a full example file, basically start to finish, so we all have the correct kind of starting point to determine kind of a base, right? So we have a ton of different programs that all use typically 12 or 24-month bank statements. So as Jose said, we're typically always going to go with 12 as the preferred option. So for my demo here, what I've done is created 12 fake bank statements. I have not done things like fake NSFs, Jose. So I did not create a scenario for that. All I've simply done is created some random transactions and some random names of excluded transactions that we'll just have to go through in order to calculate the income. So right now it's just a demo for calculating income, which is going to be the same really no matter what program we go with. So let's go ahead and go through just a demo of how to calculate the income, and then we will go from there. So I have my sheets up here. Let me go ahead and share my screen for everybody. And you see here, I have created for ease. Again, this is obviously not a real bank statement. I took a bank statement, I converted it to a Excel spreadsheet, so it would actually just put them into a cell so I can manipulate it. And this is basically a bunch of fake data, right? I put fake numbers in. Obviously, balance is totally fake because there's, deposits and transactions, for both debits and credits. So basically, the first thing that I want to make sure we do is we're just looking at deposits. So no matter what kind of bank statement we're looking at, we're just going to look at deposits, right? We don't care about any expenses at this time. That's not for us to determine when we're calculating the income. So in order to do that really easy, I opened up the PDF of a bank statement. I pressed create Excel so that I could just get the numbers. I deleted all of the expenses, and I've only grabbed the deposits. Now for this example, this is just 1 month. You see I have here monthly data. I just populated with a bunch of random stuff. And we're going to transpose that onto our sheet here for our calculator. So let me real quick full screen this. Just a simple calculator we have from one of our partners here. And basically, we're just going to type in the deposits here for business bank statements. So there's different sheets for personal, business, etc. But in this example, it was a business bank statement. So we use 12 business bank statements is what we're going to use here. It's going to be January through December of 22, which is great because we're in January of 23. So it's a perfect calendar year is going to be our 12 bank statements this year. So it's a nice, great example for us to, record here and all get on the same page. And basically, this allows us, if, for example, do a lot of like deals for our realtor partners, right? They only have like 1 or 2 commissions a month. The rest are kind of not business, right? They'll give me their personal bank statement. I'll have to go and just grab the couple transactions. So in this case, it's nice to just grab the couple 2 or 3 a month transactions. What I'm going to do in this example is I'm going to actually total everything so I don't have to type in 32 different transactions here that I have in my example. So I'm going to total everything. And then what I'm going to do is I'm going to exclude the ones that are not income. And that's where the challenge becomes. So you can either just type in the ones that are income. In this case, we'd have to just type in the ones that we know are income and type them in here so it adds up. Or what we can do is just total it. So everybody knows how to use Excel for the most part. If you don't, obviously there's all kinds of cheat sheets on this, but it's real quick because you can just press auto sum and boom, in one click, now I have the monthly income for this business bank statement. So this business had 145,624 in deposits. So a lot of bank statements will total your deposits, right? Doesn't matter what bank you're in, your customer has, you'll usually see a total, and you can usually get this data. Now, what we're going to do with this data, we have to subtract some non-self-employment income. So a lot of times we get this a lot on the personal bank statements. So I have a couple examples that probably wouldn't be relevant to a business bank statement, but there are some that are. So in this example, we're coming through here. We're going to have to read every line by line. Remember, we can only use deposits that are related to their self-employment activity. So these, in this example, this is like a store or a restaurant or whatever. So these are just ACH from credit card transactions, right? These are just the POS, whatever transactions they're running at the retail location. They're just popping in every single day. They're getting a credit. However, you notice this one is coded differently. Loan deposit. Any loans are not income, right? So say this was a quick loan or a payroll loan or whatever it was. Obviously, I put a random number in here for the amount, but this is an excluded deposit. We cannot use this for our example. So one thing I'm going to do here is we're going to have to exclude this non-employment income. So I'm going to add this loan deposit. I know I'm not going to be able to get that. And I'm going to continue to add any other ones that are excluded. The other one that I wrote in here that's super common is for self-employed people that are using it for personal, is you'll have a Zelle deposit from mom for rent, or from wife, or from spouse or husband, whatever it is, for rent or for throwing it on a trip, whatever it is. We cannot use Zelle deposits. That's not self-employment activity. We also, in the case of businesses, in this business, you might have a vendor refund, right? Remember, a refund is not income activity, right? So in this case, we might have an ACH credit and then an ACH refund, whatever. Customer wanted a refund, whatever it is. We're going to have to exclude that. It can't show up as income. So in this case, we have three very clearly excluded deposits that we're going to need to exclude. So I'm going to add these up. And then I'm going to, again, use my tools here. I'm going to auto sum these. Actually, I can't use the auto sum. I'm going to have to subtract. So I'm just going to go equals the total minus the excluded. So our total here that we can actually use for the month of January for this borrower is going to be $136,532.51. So you see this spreadsheet is all programmed, so it's adding the income. So total deposits, right now we got this. We got our first month done. It's going to start to create some income figures for this borrower. So let's go ahead and kind of power through this. Hopefully you guys see the example. I haven't done this. We're doing this together. So even though this is all fake data, this will be a good example. I don't have like the cheat sheet. We're just doing this as we go. So let's pop over to February. And again, go through the same thing. We're going to total it. We're going to get the excluded deposits. Boom, I put a loan deposit here again. What else did I put? I think mom again and vendor refund again. So again, I kind of just used the same example. And this cell is going to equal the total less our excluded deposits. So this month we have $814,964.04 worth of income. So now we're getting up there. Boom, boom, boom. Let's do this quick.
Hey, Jose, while he's adding some of those up, so Alessandro in the chat had a question about the Zelle, Cash App, Venmo. Will Zelle, Cash App, or Venmo transaction be considered for self-employed income in general? Do you want to touch on that?
I'm sorry, could you repeat your question?
The question was, will Zelle, Cash App, or Venmo transactions be considered for self-employed?
Well, if it's a business-related transaction, like, for example, Nick has Zelle from mom, unless mom just bought some product from you of your company or whatever your business is, that would be a personal transaction.
Yep.
But
This is
if
a
your
pizza
customers
parlor,
pay
and
you,
unless mom bought 2,000 worth of pizza, that's not pizza activity, right?
but yeah, exactly. But if your customers pay you and Zelle is one of the options and you have it, and this is one of the cases where you would have to look at where the loan, what the guidelines are, what we're going to do with it, because we have to consider if we are going to be using personal bank statements for something, like possibly they may have the Zelle connected to a personal bank account, and then using the business bank statements for other things. So we have to make sure all of that is understood up front so that we can properly structure the loan accordingly.
Here's another one here, guys. Insurance refund. So this guy made an insurance claim. An insurance check is not income, right? So boom, we're going to subtract.
What I also wanted to note is that in some of these forms, depending who is underwriting the file, they may ask you to put the gross deposit amount there, and then put minus, going to the right, the items that you are not considering, so that the underwriter can see the deposits that you are excluding.
Mm-hmm.
So yeah, like in short, right, Alessandro, if you had like so Jose, say I was a barber and everybody paid me through Cash App and Zelle to my personal account,
Awesome.
right? That would be fine.
That would be an ideal situation, because a lot of those cash businesses, they never go through Zelle, and then they don't deposit them. Now, it doesn't matter if he takes cash; that's fine, as long as he deposits the cash every day. Then we have a deposit stream. That's not a problem.
Perfect. So perfect for those type of borrowers.
Yeah, this is what how we thrive, and you can get pretty creative with self-employment. They don't have to have an LLC, as long as they can get a third-party verification letter.
So this one, I just put 2 random Zelle deposits. So since I don't know what they are, we're going to have to exclude them, guys, because unless we can prove that they were pizzas, right? If this is a pizza parlor, unless someone dropped $7,000 on a Zelle deposit on pizzas, probably not a pizza-related deposit, right?
I might do that. I like pizza.
I mean, unless if you ask them now, you could ask them what was that deposit, and if they state that was business related, then they would have to document it. So if they don't document,
say it was like a catering, right? Oh, it was catering. Yeah, that was a huge catering event we did. Oh, great. Let's put that back in. So we can add that back in if we get a document. But like these regular deposits that are just from their credit card terminal, we don't really have to document, a daily deposit on those. That is, one thing we'll document that. But if you have a one-off, you're definitely going to need to document this entire thing if you want to grab this $7,300 and you claim that this was a large event or whatever, right? Mom doesn't count, but large event, 1,000 pizzas is totally fine, to count in there. That's Jose's example.
And please keep dropping your questions in the comments as well, and we'll answer them as we go.
And let me just get these. Just making up fake data, and we're just going through this together.
By the way, there are some outlets with a concierge service. I know some of you tuned in to this. We've had some people on as guests talk about that, to where they will actually do the bank statement calculations for you. So
they'll do exactly what I'm doing right here. But remember, they don't understand what the difference in the Zelles are, right? They're just going to exclude stuff, right? So only you, as the MLO who has interviewed the borrower, knows who the borrower is and says, hey, what is that Zelle? Do we have a receipt for that? Do we have an invoice for that? Do we have a document for that? Is that actually business activity? Are we going to be able to capture it? So remember, if you're using a processor or someone to help, like a service, it's only as good as what they understand about the file. So again, that's why we love our MLOs to be in control at all times, guys, because this stuff is real tricky. Look, 2 loan deposits this month. Mom Zelle, vendor refund, and another Zelle that we can't explain, so we need to exclude it. Almost done, guys. This is boring. Sorry. We'll get to the more exciting part here in a second.
Oh, this is great. So somebody's asking here, Jose, for Airbnb income, can we do a DSCR or would bank statement be better? Jose, you there? Oh, we can't hear you. You're muted, Jose.
Again, I think at that point we would have to read the guidelines. Typically, I haven't had a bank statement option that's a DSCR. I mean, that's not DSCR. Excuse me. I haven't had bank statement option that's short-term rentals, because for the short-term rentals, when you have something like that, they have to provide a lease for the bank statement. For the bank statement option, you definitely need a lease. So short-term rentals will not work, which probably explains why I haven't had any bank statement option that had short-term rentals. Because if we look at the guidelines, I'm pretty sure that I've read it, that you have to provide a lease to document the flow, and then you have to obviously have the bank statements to show the deposits coming in that match what the lease states. And then usually, again, depending on guidelines for the program, we allow 75% of the gross lease amount, gross deposits, to go towards the income. So the rental income is always treated differently than self-employment income when we're doing bank statements.
Right. So yeah, but we definitely do have programs for DSCR. For
short-term rentals. Absolutely. I think the last 3 that I've submitted were all short-term rental components to the DSCR. So for sure, we have it for purchases and for refis.
Boom.
So here, Natasha's saying I can do Excel, but does the company have a spreadsheet created that we can use? Yeah, that's what Nick is actually using, right? At first, he was just adding up their actual income, which of course, you got to do that somehow, some way. But now he's using the sheet that we've actually provided. And before you do this, real quick, Nick, one more question before we get to the rest of this here. Jose asking, what about seasonal self-employed borrowers, like in agriculture, stuff like that?
Well, at that point, you would have to show, and that's going to be the same. This rationale is going to be the same whether you are seasonal, and it really wouldn't be so much, whether you're self-employed or whether you're hourly. If you're seasonal, you're only going to have income part of the year. Like, I guess if you're a roofer, where places where it snows, you don't put up roofs probably in the snow time of the year, right? So that'll be maybe 3-4 months out of the year. You may not be putting roofs. So if you can show a continuity of doing that, whatever the guidelines say, it may be 2 years, 3 years that you've been doing seasonal employment like that, kind of a income cycle, then they will accept it. But it can't just have started. Like, you can't say, oh, I'm seasonal and that's why I have a 6-month gap. You have to then show, 3 years worth. So it's going to be a little tough, but you'd have to provide like 3 years worth of bank statements, 2-3 years, and go back and document.
And it would be okay, right? Because we're going to average it.
Well, yeah, the average, and also it's showing the trend that this is actually a recurring theme. It's not just that you had a bad year and you're trying to tell me now you're seasonal. So, okay, if you're seasonal, show me, okay, we have this year's and last year's, and I don't know what else they may ask for, but they're going to ask to document that seasonality.
All right, go ahead, Nick.
Yeah, so this thing I think it wants us to enter a P&L, validate it or whatever. to make sure that we have a third-party validation to enter it in here.
That's if you go profit and loss because you want to get a different expense ratio. But
Yeah, I'm saying it's just trying to pop this in here. I don't know why it's not using it, but you should be using whatever value we're going to have here. So this is going to be for P&L, as Jose said, which is going to pop in a number here based on the best of all of them. But your bank statement, so let's leave the P&L out of here, right, Jose, and not have it make a determination for us. And we're going to see here our 50% ratios and our expense ratios. So, Jose, can you explain a little bit about how we can get from this side of the equation to this side of the equation? Because you guys notice we're doing 12 months here now, guys, because we only put 12 months in here. So right now, based on what we input, if this person owns 100%, they're going to get $76,000 a month using this calculation. Or if we can get this calculation, they're going to get $99,000 a month in income. So Jose, can you touch on those differences?
That's what I was explaining a little bit earlier, but this shows it in much more detail. When in the center part there, we're using the default 50% expense ratio. And then in the part that you highlighted there, looks like it's a 35% expense ratio.
Yes.
And in order to get the higher profit margin, then the tax preparer or accountant or CPA, whichever of the three, has to prepare a third-party verification letter stating all the typical verbiage, plus at the end adding an additional line there that what your company's expense factor is. So if they're going to put your expense factor is 35%, you will be able to capture 65% of the deposits instead of the default 50%. And in some cases, you could be a really low overhead business, like a real estate agent that maybe has, cell phone and gas and maybe car, whatever. And then if you get the letter from the CPA or whoever provides it to you, tax preparer or accountant, then you could get, maybe a 20% expense ratio and get 80% of your income, whatever you can convince them to accept. Obviously, they're going to be looking at your bank statements, and they're going to be looking at what's going in, and they're going to be looking at what's going out. And if you try to squeeze too much out of the situation, they may say, well, we need more documentation, at which point it may or may not work. That's the method and the documentation that they're going to ask for in order to go above the 50%.
Now, to go the other way on this, for example, if this is a pizza restaurant, we're going to be lucky to even get a 50% ratio, because a pizza restaurant does not have 50% of the income of gross income as cash flow typically, right? Cost of goods sold is typically like 75% for a restaurant. So,
yeah, we have to be very careful. That's why we have to analyze this very carefully in the beginning as an MLO. Look at all of our options and variables and make sure that we pick the correct trajectory for this loan, because in some cases it will be more of a factor than others. Sometimes underwriting can be more proactive and say, hey, wait a minute, like Nick said, you're a pizza restaurant, you have low margin, or you're a contractor and most of that is for materials and this and that and no way, and all of a sudden they're hitting you with 70%, 75% expense factor. So it could go in the opposite direction real quick. So that's something that we definitely want to consider up front and make sure that we have those bases covered.
So in this case, if this is a pizza restaurant, we're going to be lucky to get this, right? So we're not gonna go for anything above this. And also, we don't have any documentation. So if this example borrower hasn't given us any letter that says there is some other expense factor, we're going to have to just use this 50% ratio, which is the default factor. In this case, in my example, this guy makes a ton of money, right? So with the 50% factor, $76,000 a month is a lot of income. typically a borrower doesn't own 100% of a company unless it's like a self-employed realtor, right? So this person that's a self-employed pizza chain owner typically will have some other partners. So that 76,000 in income will need to be distributed based on how much they own of this business. So for this example, I'm going to use 50%. So say this pizza restaurant chore owns 50% of the restaurant and therefore 50% on the K1 on the LLC, and therefore is going to receive on their 1003 50% of the qualifying income. So we determine based on this business's bank statement, this business has a 76,248 monthly qualifying income based on a standard 50% ratio. So this next step, now that we've calculated the income, I'm actually going to save this as well so I can send it to everybody on our team here, is we're going to type the income into the loan application. So this is where we can start to really see how this is going to affect us. So let me open my actual Encompass here, and I have my actual test file with John Homeowner, obviously the Fannie Mae test file with fake data here. But let's go ahead and go through this loan application and complete it based on this hypothetical. So our first part here, just address, owns it, great. Credit, we don't have credit, it's fake. Fake address is what we have here. We can put a fake property type. Purpose alone, we're going to say a purchase. We're going to say, we'll do some rates here in a second, Jose. That's where it's going to get a little bit exciting. Once we put in the income and stuff, 5% note rate for a bank statement is probably not realistic. Let's start at like 7.5. Probably be lucky to get that right now, but that'll be a good start point. In this case, it's a $425,000 purchase with 20% down is our basic scenario. This was just the Fannie Mae test file that I had pulled up. And let's go through the lender page. If your guys' LOS is different, if you guys are watching, same idea as everything on here. But let's just go ahead and get some data in so that we can pull pricing, and we can most importantly check out our DTI factor that's going to change significantly when we change the income. So everything else here is the same. Yeah, whatever, John. All this is already set up, just a basic purchase scenario. Page 1. Nothing really needs to change here. Mailing address. Page 2 is where the magic happens. So again, since this is a Fannie Mae test file, it's just a fake place to work. And what I did earlier is, obviously this Fannie Mae test file had a fake W-2 job, so this wasn't checked. Remember, I hope you guys can see this. I know it's really hard on this screen. I wish I could zoom in a little bit more. Remember, if you're self-employed on your 1003, you have to check this self-employed box. And typically for the bank statements too, we're going to need to be more than 25% as well. So we're typically always going to have this checked off on these business bank statements, and we're going to put our self-employed monthly income. So in this case, remember, it's 76,000 in our income, but if this person is a 50% owner, not a 100% owner, we're going to get 50% of our qualified income of this business because they own 25% of this business. So let me put in, so instead of $12,000 a month salary, which was great salary, and he would still qualify, this borrower, this example borrower is at a 23 front end, a 33 back end in this example. DTI up here, if you guys can see there. I know it's really small, I'm sorry. It says 23 front, 33 back at 12,000. Now we're going to put in our bank statement income, and now our borrower is going to blow the socks off that DTI, right? Now this borrower could go from maybe not qualifying for a small amount loan to really there's no limit now to the the purchase price. I mean, obviously you're not going to purchase a $3 million house or whatever, so you could go up crazy amounts in purchase price in this scenario, and this borrower will still be under a 50 DTI on the back end, which is going to be our typical limit on the non-QM bank statement programs. There are some non-QM bank statement programs that even go up to 55 DTI on the back. You have to stay under a certain LTV. But going from a 33% DTI to a 10 is a very significant change, right? That's 3 times the income, more than 3 times the income that we got there. So they're going to qualify for 3 times the house or even more. So that's where the difference happens. That's where the magic happens there. Even with only half of the deposits, we're still blowing the socks off our W-2 income. Now, let me make sure I have everything else set up so we can pull up some pricing.
Nick, why don't you increase the amount there so people can visualize how much more that borrower could qualify for?
Yeah, for sure. Yeah, we want to push it. So in this example, we got some down payment and we got another mortgage here that's just mapped. So it looks like there was a good example here. Departing primary, I guess here we'll say pending sale. Oh, pending sale it already is in this example. Okay, cool. So I think I have everything we need to run the price here. Just want to make sure all our pages are complete. And it is primary, so this should show up as a primary when we price it. Okay. So as Jose said, we might want to come back here to the price and say this borrower instead of buying a $425 house wants to buy a $1.5 million house, which is obviously a whole lot more house. Oh, that's 15 million. My bad. Can't quite get 15 million, but they can qualify here for the $1.5 million. And they could put down 20%. And you see here their DTI is a 23 front, 26 back. No sweat qualifying for $1.5 million house because of the new income calculation that we've done here. So obviously you could push the limits even further. Let me set this back to normal though, Jose, so when we do pricing, it doesn't hit any max loan limits.
Yeah, I was just saying up it a little, yeah.
I mean, most people's eyeballs will grow once you double their qualification. So we'll put 750 here. So we stay under all the loan limits and stuff.
You're gonna do 80%, or why don't you do 90% LTV?
90?
Yeah, let's do a 90. I think.
All right, let's see if they can put 10% down. So we do have some options on the non-QM bank statements that should do 10% down. They have been getting restricted, right? Some people dropped it to 85 LTV as a max. Some dropped it to 90, but let's see what we got. We are going to need a credit score estimate. So, but let's go ahead and pull up our pricing here. Well, I don't know if I can price it live with the thing. Let me see. Let me pull up the public pricer. And we will pop her in there. Pricer quick. Yes, this one. Okay. So let me try to full screen this for everybody. And what was that loan amount that we had there? What did we do? 750 with 10% down?
We were doing 750 was the purchase price, and we were doing 90% LTV. So not sure. I guess I gotta do the reverse.
Boom, and we're gonna go expanded. Our PMI, there actually is no PMI on a expanded, so that's great. Let's put that in. 760 FICO is what we'll use for our FICO estimate, primary, single family, everything else the same. And in this case, we use business bank statements, right? So we're gonna go business 12 months, self-employed, and let's see what we got. All right, we got a couple options here. So what do we have? It looks like our best option is this one. 8625 rate for 0.875 discount points for 90 LTV. Sounds pretty good to me. All these other options are a little more expensive. Those are more for like credit event types people and stuff. So I guess we'll go with this top one, right, Jose? What you think?
Absolutely, man. That is an amazing, amazing deal. That borrower is going to be so happy.
All right, so 8625 for 875. Let me exit my pricer and put our note rate in. And for those loan officers that know how to work the pricing, I'll just go ahead and put the points in here just so y'all can see it. And points are going to be 0.875 in points there for our cost. So in this case, you guys see the math just got done there, 5,900 in points to get to that rate. But the final DTI in this scenario for this 90, for some reason our LTV got messed up. Hold on. What happened there? I don't know what happened up here. The LTV calculator went crazy. I don't know why the LTV went crazy. There must be some other weird setup on this file for another mortgage or something. But the point is the DTI is good. So we're still at 18 DTI for a scenario that would not have worked with his regular income. So again, let me pull this up. If his eyeballs, this borrower's eyeballs were bigger than his pocketbook, if they wanted to do a regular conforming loan and they only had, also in this case, hold on, Jose, we didn't even put in, there's some weak estimates, but a $750,000 house, we're probably going to need more like $200 a month in insurance and quite a significant more amount in taxes, probably more like $600 a month, right? So in this case, the final DTI might be something around 19 for this borrower with the bank statement income. But again, let's pop back in here. And if they were if they were self-employed still, but their W-2, their regular tax return income might be only $12,000 a month, which is still great. But notice this borrower does not qualify. Their eyeballs were too big for what they qualify for full doc with tax returns. We're at a 60 back end. I know you guys can barely see it here. We're at a 50 front end, a 60 back end. There's no conventional loan options for that. There's not even any bank statement loan options for that DTI calculation there. So using these bank statement income calculators where we can get a whole bunch more income, I forget the exact amount, but it was 38,000 and change. Totally changes the game on the DTI and turns a non-qualifying borrower, as you see here, to a qualifying borrower with real rates as of right now, live, and all that good stuff. So that's pretty much it for the demo stuff. Anything else, Jose or Kyle, that we should go over on the screen share part here?
I don't see any questions that are going to be pertaining to that, but Angelique has a question here. Where would you look up the cost for the insurance and those items? She said, I know you did it off the top of your head. I'm not able to do that yet. As far as the insurance and the taxes, I think she's referring to.
Those were just estimates, right? So you guys would need to know your market, right? But you can always go and get instant quotes from a lot of different places. That's what I love about. I can't put the old. Oh, I can. Hold on. Let me see if I can show this. Show. That just shows it over the whole thing. Well, there's her comment though. There we go. Okay, so now we can show them while we're responding to them, Kyle. I would look it up via one of the online calculators. So there's all kinds of different online insurance marketplaces where you can get instant quotes, like Lemonade. I love to use. They just don't always work in all the markets. So in like Florida, there's no instant quotes because it is hurricane insurance and all kinds of other stuff that goes into those quotes, flood, all kinds of other stuff. So a little more difficult. You need to know your market and get a good estimate. And if you don't know, great opportunity to pick up the phone and contact a partner, right? A future insurance partner, right? You guys all need an insurance agent you partner with that you can get good information from, and hopefully vice versa, right? They should be able to use you as a resource. So feel free to reach out. They need you, you need them. just like all those other service providers that we have, title companies, all that kind of good stuff, to get those little tidbits of information and get us great costs. And then taxes are public, right? So anytime your borrower says, I want to buy this property, just go type it, just go look it up and find the taxes there. It's public info for the taxes. So that shouldn't be too hard. And now we can start the next one here. Armani, bank statement is only self-employed business owners. Yes, so the bank statement is only for self-employed. As Jose mentioned before, there are opportunities to do mixed income. So if this, in our example here, the pizza place, wonderful place, right, was, I guess we could say, because this was John homeowner, right? So this is husband's pizza place, but say spouse, wife, has a W-2 job. We can still use spouse's W-2 income, but we're going to have to do a bank statement loan. So the pricing's still going to be, the higher rates of a bank statement loan, but we can still use wife's W-2 income, for qualification purposes. So a little bit of a trick question. You can do mixed income, but remember, we're always going to have to go to the more expensive rate option, right? They're not going to let you use bank statements and then give you conventional pricing. It just doesn't work like that. You always have to go to the higher priced scenario there.
What if one borrower? I'm sorry. Go ahead, Jose.
I'll say, but you do have to be self-employed of some type. You don't have to own officially a business. You don't have to be incorporated. You don't have to be an LLC. You could be as simple as a handyman that does painting, and you can get that verification letter, that third-party verification letter from the tax preparer, and you have the bank statements because you've been depositing the cash or however they pay you, then you don't have a problem.
All right, perfect. What about a borrower? What if a borrower is self-employed and they have a W-2 as well, and they have a self-employed job on the side? How does that work?
We did touch base on that. I think I have one. We have one of our MLOs that recently submitted a file like that. His borrower, and I'm very curious to see how that one turns out. His borrower has self-employed income. He also has W-2 income, and he also has rental property income. He has all three streams coming in. And
the trick there is you got to be careful not to double count it, right? So exactly. If it's already coming through on the bank statement, you can't just throw W-2 income in there if it's the same business, right? You can't double count, right? Because how did he get a W-2? It's catch-22 there, so you got to be careful.
Yeah. In the ideal situation, you would have segregated bank accounts, right? Where the real estate income, the W-2 income, and the self-employment income go into separate accounts.
Good luck finding that. Okay, I don't see any more questions, and it looks like we're coming up right here on an hour. So I think we can go ahead and wrap it up. Anything else?
Let's pull up this question by Matthew here about the P&L, if it's better than their standard expense ratios. So remember, the P&L is going to be the same expense ratio. So the same letter that you're going to need for an expense letter that says, hey, this borrower approximately expends this much per year, I do their taxes, is going to be the same as the same letter that says this is how much they expended, right? So P&L is an actual figure. A CPA letter of an expense ratio this is about how much typically their P&L is. It's just kind of an opinion, but technically you're asking about the same number there, Matthew. It should be the same number, right, Jose? Is that?
Yep, has to be the same. So it's a lot of work. If you're going to do that P&L, that's because you're really trying to reach a high profit percentage, something that they may not just accept in the letter. Like, no, that doesn't make sense. Give me the P&L. If you want to get that 90% or that 88% profit margin, then you got to prove it in the P&L instead of just the third-party verification
letter. Let's see here. Angelique asking, how many accounts can you link to the bank statement loan? So how many accounts can you use on one loan, Jose?
Unlimited.
Yeah, I mean, it depends if it makes sense. Again, we have to know how many accounts there are so that we can properly structure the file, because there are limitations depending on the program, right? There's multiple bank statement programs. They all have different guidelines. So we got to make sure we pick the correct program so that accepts multiple banks, personal and multiple business and multiple personal. I'm not sure if they really want you like to go January was this one was from the business and February was from the personal, but they may accept that if you have a really good interconnecting thread of the deposits. If they're all business related deposits, they could let you use different accounts. But again, we need to know that from the beginning so that we can properly structure it for the right program.
But I mean, the answer is unlimited, though, right, Jose? I mean, there's really no limit. We did that one dude that had similar businesses, but I mean, he had I think 6 different accounts of 12 statements, and we ended up using 3, I think, on that one big complicated one. And the borrower could have qualified for much more home, about $1 million home, but we only needed 3 of the 6 business accounts that he had. And we chose the cleaner ones, right, Jose? We chose the ones that didn't have as much explaining to do, right? So same thing you guys want to consider here. How much work do you want to do? Well, not necessarily you, but you and the borrower, right? You guys are in the same position. We want to make sure we make it easy for all parties involved so that we're not all doing work that we don't need to do. So, for example, what was that, Matthew's question about the P&L, if we don't need, in my example, right, $76,000 is more than enough. It's 3 times more than he needs. So why are we going to worry about doing an expense ratio? Even if we could, we don't need to. So we want to make sure we're careful there. Same thing with that Jose did. He only needed 3 of the 6 business bank accounts to get enough income to qualify. So why are we going to send 36 more documents that could have a weird NSF or something weird that we have to explain when we don't need to necessarily? We can still qualify without it. So good questions there. Another good question. Angelique's on fire here.
Angelique was just activated on our team today. Welcome to the team, Angelique. Just activated today.
You need a CPA, third party, or P&L. Those are all kind of interchangeable as the same thing, right? We need verification. So we need a third party to verify. Typically, that means a CPA letter. Third party to verify letter just meant CPA letter. So those 2 words mean the same thing. And the P&L means that if you want to use a P&L, you have to have a tax preparer sign off on that P&L, basically. So a little bit different things. Third-party letter is a letter from the tax preparer. You need that regardless. If you're going to use an expense factor or do a P&L where the actual P&L is written, you're going to need them to state that expense factor or actually help prepare the P&L.
And when you say third party, I'm sorry, go ahead, Jose.
And in some bank statement programs, because again, there are multiple bank statement programs that we have as options, may just straight out require the P&L. So that's why you have to be very careful of which option is selected, because that's what's going to determine the document requirements.
Yeah, notice Amy was the one that was commenting on that. She went on a mission high and low to find an investor that didn't require it. Ended up getting asked for it a couple places that she wasn't expecting it, but they are hard to find. So they're out there, but they often do ask for a third party of some kind, and a lot of times you're stuck with an accountant letter. There's really no other way to verify for a lot of these types of loans, so you can't really get creative too much on that letter.
And when you say third party letter, does it have to be a CPA?
Nope. It can be. I was just about to state it does not have to be a CPA. Just that for whatever reason in the guidelines they like to put CPA letter. I guess to discourage. I don't know why they do it, but it could be a CPA or an accountant or a registered tax preparer. Whoever does the individual's taxes, I guess whoever he can get the letter from, as long as they are one of those 3 will be usually acceptable.
Okay. And speaking of taxes, Eric is asking, what if the business owner does their own taxes?
Well, yes, I've had that, and it was a mission because the borrower didn't want to go on the mission to get the a tax preparer because whatever they were going to charge him and the time factor, obviously. It's just a letter, it doesn't state income. In that scenario, the person owned 7-Eleven, so we were able to get a really good letter from 7-Eleven, and we're able to get the exception to get that letter accepted. But that was an exception, so usually now again I defer to the guidelines of the program that is selected again, because in some cases if you can get some type of third party verification from like a municipality or something like that, they will accept that. But again, that's on an exception, case by case. The easiest that's not going to fail would be the letter from the tax preparer / accountant / CPA.
Good
All right.
questions.
I think we can go ahead and wrap it up. So we do these every Tuesday, right? So you can tune in Tuesday, 7 p.m. Eastern time, right here on YouTube. And we also go over the live rates every morning, as most of you know. So 11 a.m. Eastern time, right here on our YouTube channel, we go over the live rates every day and talk about the different programs. So you can tune into that as well. Thank you, everybody, for tuning in. Thank you for the great questions. That was awesome. Thank you, Nick and Jose. And hopefully we'll see you all tomorrow on our live rate webinar and next Tuesday at 7 p.m. Eastern. Take care, everybody. Have a good night.